All right, so just a few minutes into this live stream, and somebody's already asked me to remove my clothes. This is not that kind of live stream. We're here to do tax advice, financial planning questions, things like that. Taking off the clothes, that's going to cost you. But thanks for the question. Appreciate it. All right, so we have a Reddit question here from Turtle Sweater 42 asking, why am I on Reddit? And I'm sure you're referring to the fact that this is a tax filing deadline being March 15th. That's the deadline for S corporations and partnerships. So what I do in my practice is that I allocate my time so that all of the work can be done throughout the year, so there isn't a rush on the deadline to get everything out the door. So I let my clients know well in advance that there is a deadline approaching. We set expectations as to when we want to see the information. And if information isn't provided by certain dates, for example, for March 15th deadline, we're talking about March 1st. If the info isn't there, then we extend. So what that allows us to do is manage client expectations and manage the bandwidth at the firm so that we're not rushing to get everything out the door on 3/15. So that's why I said, hey, we have an opportunity to help some people out. I have a little bit of free time right now, and everybody's kind of stuck at home, so why not answer some tax and financial planning questions? So thank you for that question, Turtle Sweater 42. I hope that answers it. All right, so we got a question here regarding S corporation entertainment expenses as such, and having meals with clients and so forth. So meals and entertainment used to be an entire category that you could deduct for federal income tax purposes, and usually for state income tax purposes as well. But it was subject to a 50% reduction. So if you had $1,000 in meals and entertainment expenses where you were discussing business with clients and prospects and business associates, what have you, you would generally be able to deduct only $500 of that because of that 50% limitation. Now, if you take into account the fact that the Tax Cuts and Jobs Act has pretty much taken the entertainment part out of the picture completely for federal income tax purposes, you're only left with the meals. All right. And that doesn't include alcohol either. So you want to just keep it to the meals themselves that you spent for discussion of matters with prospects, clients, business associates, what have you. And that's still a subject to the 50% limitation. So even if you're an S corporation and you spend $1,000 to take clients out to a meal, you'd only be able to deduct $500 of that federal income tax purposes based on that 50% limitation. But thank you for the question. Appreciate it. I know there's questions out there because all day today I was getting calls from people with all sorts of tax questions and can you help me with this? Can you help me with that? And it becomes very difficult at this time of year because we're generally working away trying to get tax returns out the door and everything filed by the two important deadlines being March 15th and then April 15th for personal purposes. Now, the interesting thing is that the IRS may push forward the deadlines based on this coronavirus thing. We don't know yet. So if that becomes the case, then you may be able to file your taxes later. But the question is, how's that going to affect payments? Because generally extensions don't affect when you pay the tax. So even if you were to extend, let's say today for your partnership, what have you, if you have state tax liability for that entity, you may still have to pay today, even though you get to file your returns later if you extend. So the big question with this coronavirus thing and how it impacts estimated payments is yet to be seen because nothing's really been released that's all that official. A few states are now allowing some extensions, but you got to be careful because you have to understand specifically what's being extended, whether you can file later, pay later, or both, or if you have to still pay on time and you can file later. So generally, it's advisable if you can extend in a timely manner, do so without having to rely on any sort of government intervention to allow you to file later. And that will probably keep things running as smooth as possible. But there may be some kind of provision released shortly here that will do something to the tax deadlines. We don't know yet, but we'll see what happens. And certainly I'll jump on the YouTube channel here once some news comes through and I'll let you guys know about it. So feel free to subscribe. Okay, so we got a question here about whether toilet paper is a deductible business expense. If you're buying it for the office, most likely, but you have to take into account that it can't be lavish or extravagant. So if it's, $20 or $50 or $100 bills, then that may cause an issue in terms of a deduction. But in general, yes, if those are business-related office supplies, absolutely take that deduction. All right, so somebody on Reddit has just said, you're cute though. I appreciate that, but let's try to keep this to taxes. I know that this can be distracting sometimes, but let's try to focus on some financial planning and tax questions this evening, okay? Appreciate it. I got my gallon, by the way, of black tea here, so I can be here all night, people, so I'm in no rush. All right, so taking a look at Reddit, there are some questions in the tax subreddit that I think are interesting, so I'm going to tackle some of those here. And quite frankly, this is something that's very common in that individuals underpay their taxes throughout the year and they wonder what they can do when it comes time to file the taxes to avoid the government breaking down their door. So this question is on the tax subreddit from W4UY is the name of the individual asking, and the caption is owing more than $100,000 in underpaid taxes. So question is as follows. I punched in all of our married double income family forms and numbers into TurboTax for 2019, and it turns out that we owe more than $100,000 in underpaid taxes. In case you wonder, we plan to pay them over the next couple of months via a combination of 0% balance transfer credit cards and cheap loans, i.e. margin lending. Worst case scenario, IRS payment plan. Our effective tax rate for federal purposes is 32.6%, and California is 9.7%, for a combined total of 42.3%. We also made a lot of money with some special tax events, mainly RSUs, which are restricted stock units, and a large unavoidable ISO exercise. So the bulk of the underpayment is from the RSUs and the AMT tax from the ISO exercise. So before submitting the return, I was wondering if it's worth to A, consult with a CPA, B, punch in the numbers into Credit Karma just for comparison, or C, buy the CPA live advice from some tax company. All right, so this happens more often than people like to admit, in that it comes time to file taxes, you had a great year, and then you're like, uh-oh, I have to actually pay money on these amounts. And if it's $100,000 in underpaid taxes, then you probably should have seen this coming. And this is something that you've kind of kicked down the line, and now we're dealing with it because the deadlines are coming up. So with regard to handling unpaid taxes, there are obviously a few ways to approach it. And some of them you touched on here being zero balance transfer credit cards, cheap loans, and worst case scenario, IRS payment plans. So I'm not sure I agree with the way you ranked those payment options, okay? Because if you have zero balance transfer credit cards and now you're paying tax debt with those, the unfortunate part is the IRS is sometimes more flexible than credit card companies, because if you underpay the IRS, they might assess penalties and interest, but they generally will not ding your credit. They won't show up at your house the next day and sue you for those amounts. There's a process and method to the madness in terms of how they're going to collect those amounts once it gets to that point. Now, credit cards, you miss one payment, that could seriously impact your credit. And what I don't like generally about even 0% credit cards is that you're taking this tax debt, you're putting it on credit cards, and then you're not worrying about it because it's 0%. It's not going to really affect me all that much. And you may have a year where you're not being charged any interest. So it's very easy to become lackadaisical with regard to that balance and not treat it as seriously as it needs to be treated. And then if you keep going on spending aside from that, and you're not setting money aside to address that debt, you may have even more problems with the credit card down the line. So the next option you're referring to here is margin lending. And typically the downside with margin loans is they tend to be fairly expensive depending on the amount that you're looking to borrow. So what you can do is compare the cost of the margin loan being the percentage interest rate versus the penalties and interest you'd pay on the IRS side and see what terms are preferable there. Because the penalties on the IRS level may not be as significant as you think. Now, with all that said, the first part of assessing the IRS aspect of this is really understanding what it takes to get a payment plan in place, if that's the route you want to take. And if it's under $50,000, the amount that you owe, you may be able to file online for that payment plan, and that makes things very simple and efficient. But since you have $100,000, the IRS is going to want a little bit more information before they approve your payment plan, because their question is going to be, hey, wait a minute, you got all this money in income. why can't you pay the tax, right? So then there's typically some financial disclosure that goes along with that to request a payment plan. So overall, to kind of sum this up, not a huge fan of the 0% balance transfer credit cards or 0% APR offers, anything like that, because it allows you to kick the can down the road, but then sometimes that can blow up in your face if you don't address it in a timely manner. All right. So credit cards can be particularly dangerous in that regard. Plus, if you don't pay the balance, which they don't want you really to pay it, they want you to pay interest on that. And the interest, when it kicks in, is generally a lot worse than what you'd pay to the IRS for a payment plan. And it may be even a lot worse than what you pay for a margin loan. So hopefully W4UI, that provides some clarity for you. Of course, this is not tax advice. There's no client relationship here. This is just general information for you, but hopefully this helps. Okay, so we got another question here. This one from Pels Bells on Reddit. Let me just type in a quick blurb here, and then we'll be all set to answer some more tax questions. All right. Reddit's blocking my message. No worries. So the question is, do you guys think or know if the IRS or Franchise Tax Board in California will offer any breaks on filing this year, like an automatic extension? Corp taxes are still due, but everyone is in panic and on lockdown. Thoughts? So in this case, the fact that we don't know means that you should plan for everything to be as is. All right. So if there's a deadline right now, you should plan as if you're going to need to meet that deadline, because we don't know anything at the moment. And as I mentioned earlier, we don't know if they're going to extend the ability to file, extend the deadline to pay, or both. So you may end up in a situation where you were anticipating A, but it turns out to be D, C, and E that actually happens. So you want to make sure that if there's a deadline, you meet it. And if even you need to extend by the deadline, just file a timely extension. Because here's the thing. It's not only the penalties you need to worry about. There are many provisions in the tax code that provide benefits only with a timely filed return. So if you extend on time and then you file within the deadline, before the extended deadline, then you're good in that it's timely filed. So you get a lot of those additional benefits and ability to take some deductions and credits and things like that. But as soon as you have a late return, being that you didn't file by the deadline, you didn't file the extension, or you didn't file the return by the extended deadline, now you're not filing a timely filed return. So that does limit your options, because the tax code is designed to reward you for filing on time whenever possible. So in this case, even though there's been no information really put out on many of these extensions and so forth, you just want to make sure you file it on time, at very least an extension to be filed on time, so that you have at least some breathing room. Now, I did read that California has extended some of the All right, so OBS just crashed on me, but we're back rocking and rolling. All right, so let's keep going here. All right, so I know that California extended the deadline. Let's see here. Okay, so this is from the FTB website here, and I will put this link in the chat on YouTube. Okay, so what they're saying is there's more time to file pay for California taxpayers affected by the COVID-19 pandemic here. So this was put out on the 13th of March, 2020. And they're saying that the Franchise Tax Board today announced special tax relief for California taxpayers affected by COVID-19 pandemic. Affected taxpayers are granted an extension to file 2019 California tax returns and make certain payments until June 15th, 2020, in line with Governor Newsom's March 12th executive order. Okay, so it says this relief includes moving the various tax filing and payment deadlines that occur on March 15, 2020 through June 15, 2020. And this includes partnerships and LLCs who are filed as partnerships, who are taxed as partnerships rather, whose tax returns are due on March 15th now have a 90-day extension to file and pay by June 15th. Individual filers whose tax returns are due on April 15th now have a 60-day extension to file and pay by June 15th. And quarterly estimated tax payments due on April 15th now have a 60-day extension to pay by June 15th. Here's the crux of the situation, though. The most important words in here are affected by the COVID-19 pandemic. Who is affected and who isn't affected? Because that is the key operative term here. Now it says, taxpayers claiming the special COVID-19 relief should write the name of the state of emergency, for example, COVID-19, in black ink at the top of the tax return to alert FTB of the special extension period. If taxpayers are e-filing, they should follow the software instructions to enter disaster information. The FTB will also waive interest and any late filing or payment penalties that would otherwise apply. Okay, so there is some relief that was put out for California, but the question is, to be clear, who is affected and who is not affected? Those would be the things that I would want to understand very clearly and very well before I move forward with advising anybody to delay their filing. My advice, these extension filings are very simple and straightforward for the most part. So if you can, file them by the deadline so we can avoid having to figure out who's affected by COVID-19, who isn't, and this whole thing. So I think the smartest way to move forward here is to just stick to the deadlines and avoid hassles moving forward. All right? Okay, so hopefully OBS doesn't crash on me yet again. All right, so there are yet more questions about whether S corporations will have an extension at the federal level for tax filing purposes. Again, your safest bet is going to be to file the timely extensions, because any relief that comes later may be the icing on the cake. But right now we have no idea. So your safest bet is going to be just to file timely extensions and file timely returns whenever possible, and pay on time as well. Assume the deadlines that are in place by default are going to be the ones that are applicable. And if there's relief that comes later, that's going to be all the better. But we can't guess at this kind of stuff, because right now for S corporations, we're at the deadline, so there really is no room for error. You want to file that extension definitely before midnight tonight to avoid any sort of issues moving forward. That's going to be the safest bet. All right, so we have another question here from the tax subreddit, and this one is from the Biddy Boy, and it says, haven't received S Corp acceptance/denial yet. This was an LLC that was filing an S corporation election. What do I do? It says, unsure of exactly what to do here given the fact that the filing deadline is tomorrow. Do I file an extension as an LLC and then if need be adjust it for my next filing? Thank you. So with the S corporation election, basically you send it in and you're supposed to receive an acknowledgement from the IRS that says that they've accepted your S corporation election. Now, what can happen is if you recently submitted that election, you may not have received the response letter from the IRS indicating that they've accepted it. So one thing that you can do, being that the deadline is tomorrow now, it's going to be very crowded on the phones at the IRS tomorrow. I'm going to touch on how you get around that in a second. But in terms of establishing whether or not you have the S corporation election in place, calling them is going to be one way to do that. And you can simply give them your personal information and say, hey, I just want to see if the S corp election was accepted for this entity, and they'll be able to confirm or deny whether it was accepted and also the effective date of that election. Now, you may run into a situation where tomorrow you can't reach the IRS for some reason, and now you're questioning us, what you should be doing. In that case, if you try to electronically file the S corporation election, the S corporation extension, it may be rejected. Okay, because the IRS, if they're not showing that you have an S corp in place, they're not going to accept that extension. So what you can do is send the extension by mail, make sure it's certified mail, and make sure you get that return receipt, because that's going to give you documentation that you submitted it on time, and that should help you avoid any issues. Now, going back to my point, in terms of calling the IRS tomorrow, it's going to be absolute pandemonium. So here's what you should do. All right, if you Google IRS phone number, all right, it's going to give you a link to irs.gov, and it has telephone assistance on there. Then if you pull down the link that says IRS phone numbers, it's going to give you the phone number for businesses, okay? It's 800-829-4933, okay? That's the phone number. It's on the IRS website. And the business hours are from 7 a.m. to 7 p.m. local time, which means that right around 7:01 a.m., the wait time is essentially zero. So if you call nice and early at 7 a.m., whatever your local time happens to be, you're going to be in a good spot to actually get help very quickly. If you call in the afternoon, you're probably going to be waiting for hours, all right? So as early as possible, that's when you want to do it. Now, if you're really clever, you'll get a phone number that it has an area code on the East Coast. Because if you're not on the East Coast, then you can call right at 7 a.m. Eastern time. And because if you're here on Pacific time, you can only start 3 hours later. So you're already behind the curve, so to speak. I would get it started as soon as possible. Call from a phone number with the area code that is on the East Coast. That will allow you at 7:01 a.m. to call, figure this whole thing out, and go from there. But right now, if the status is unknown, your best bet is probably to file the S Corporation extension by mail if it's being rejected as electronic filing. All right. So here is an interesting question from JJMY12. All right, let's get on this one. So this is employer mandated work from home. Does that result in a home office deduction, or can that provide the ability to take a home office deduction? So he says, or she, there is an enormous number of W-2 employees in the U.S. that have been required to work from home for an indefinite period of time. If someone in that situation were to set up a dedicated home office space, is there any way to use the home office deduction? My understanding is that, quote, self-employed requirement still applies, and that would prevent the application of the deduction. Is that true? Are there any other regulations that can come into play here? Now, generally, the home office deduction is available for, as you mentioned, self-employed individuals that have an area of their home that is exclusively used for business and that is regularly used for business, and that being their principal place of business, okay? So if you have, as a self-employed individual, a room in the home that you use exclusively for business, or a portion of a room that you use for no other purpose, just for business, and that's done throughout the year, then you're looking pretty good to take a deduction for home office. And the way that works is you take the percentage of the total square footage to the home office square footage, and you make some allocations there, and you can deduct possibly some of the mortgage interest if you own the home, some of the property taxes, repairs and maintenance, things like that. If you lease your place, then you might be able to deduct the portion of lease payments, utilities, things like that. But overall, you have to go back to those requirements that there must be some business activity. If we back up from that, there are situations where employees have to maintain a home office and they're required to do so by their employer, and their employer does not provide any other means of working, meaning that is their principal place of business as an employee. Now, before the Tax Cuts and Jobs Act, these expenses would be lumped into a category called 2% miscellaneous itemized deductions that would end up on Schedule A and possibly create a tax benefit if they were substantial enough. What the Tax Cuts and Jobs Act did as of tax year 2018, it was eliminated the vast majority of those 2% miscellaneous itemized deductions completely for federal income tax purposes. So if you're looking at the federal tax return, those deductions aren't going to be there, period, because that's just not an available deduction anymore. After 2026, it might be a different story. But for now, not a thing. For state income tax purposes, they may allow those 2% miscellaneous itemized deductions depending on the state in which you reside. In that case, you may get a benefit at the state tax level. People generally aren't as excited about that because the tax rates in general are lower at the state level, so there's not that much bang for the buck. But certainly, if you have significant expenses as an employee at home, that might be an available deduction. In this case, though, the situation that you can run into is that it's not really your principal place of business. It's a temporary office location that you're using during this pandemic that we're having. And that's where I would hesitate to take the deduction. I'd need to do a little bit more research on it just to see if that's possible. Because if you have 12 months out of the year and then you spent 2 months working from home, that's not really your principal place of business when you look at the year overall. That's just going to be a small portion of the year. So that being the case, I would hesitate, even if the states allow it in this particular situation, to take that. Totally different story if you were self-employed and you were using that aspect of your property for the entire year for business. Totally different. The fact that you're an employee and it's a temporary stint of using the home office, that would cause me to hit the brakes in terms of deducting it because of that principal use requirement. All right, so hopefully that helps. All right, so we got another question here on our tax. This has to do with dry cleaning expense for real estate agents. So Buddha Boy asks the following question. I hear conflicting advice from my colleagues. Are dry cleaning expenses for real estate agents a tax deductible business expense? Now, if you're using just general use business suits and business clothes and business attire, then your dry cleaning expenses are unfortunately not deductible because there is a sort of a personal element associated with that, and that wouldn't afford you, in most cases, a deduction. Now, I just did a live stream with Acting Resource Guru, which is a group that helps actors here in Los Angeles figure out the business and make sure that they're headed in the right direction. There were a lot of questions there from the entertainment community about what's deductible and what isn't. But if you're a real estate agent, this goes along those similar guidelines, in that if there's a personal aspect to it, you really have to take a step back and figure out if it's deductible or not. So in this case, if you're just dry cleaning general business clothing as a real estate agent, that's not going to create a tax deduction for you, unfortunately. All right, so we got a question from Chance Carter. So it says, I've been withholding additional taxes from my checks, so I have a nice refund at the beginning of next year. Is that personal preference or is it not financially sound? Okay, so appreciate the question. Thank you so much. So with regard to large refunds, this is something that people get excited about that kind of confuses me. And the fact is that when we look at finance, and this is a generalization, we want to have cash and liquidity on hand as much as possible, right? Because that allows us to invest it, that allows us to make any sort of purchases that we need throughout the year, it allows us to pay things on time, and gives us options and flexibility. So having cash as opposed to not having cash is always preferable. So it confuses me when I see people get excited about their large refund, because that is money that you didn't have throughout the year that you've given to the government to hold, and you're not getting a single dollar in interest, a single penny in dividends, any growth on it. It hurts, you know. So from that perspective, if you're looking at from a totally financial point of view, the question is, what could that money have done for you throughout the entire year? There's possibly some growth associated with that, some income, and the fact that the government has it is just static, right? And if you factor in inflation, that can even lose money for you over time, because if you have $1,000 sitting with the government for the entire year and then they give it all back to you, it could be worth a lot less than the year before, just because 3% inflation, if nothing else. So it's preferable to break even when you file your return. That means you don't owe, you don't have a large refund coming. So as much as possible, we always try to plan for breaking even when it comes time to file the return, so that there is no aspect of giving the government an interest-free loan or being subject to penalties and interest. There's a sweet spot there where you get your return done and you're essentially like, oh, you owe a few bucks, or you're going to get a few bucks refund. That's perfect, right? So on one hand, you and other people might be using the increased withholdings as a forced savings mechanism to say, okay, well, if the money's not in my hands, I can't spend it. That's one way of looking at it. If you have no other way of avoiding spending the cash, then hey, that might be a possibility for you. But a better alternative, I would say, is if you adjust your withholdings to withhold just the right amount, and whatever funds you have, you have it automatically deposited into a brokerage account for you. You could set up auto deposits so you could have $500 each week, $1,000 each week, every 2 weeks, whatever schedule you set. So if that's going into your investment account, that's actually going to grow for you throughout the year instead of just sitting at a government coffer somewhere, not doing anything for you and actually losing purchasing power after you factor in inflation. So I would keep the withholding to just the right amount. Avoid losing the value that you can gain over time, and possibly get some investments going throughout the year to actually build your wealth over time. And again, people getting excited about huge refunds is kind of counterintuitive, because it shows that the work really wasn't done up front to make sure that you get the most use out of your money and have your money actually working for you. All right, so hopefully that helps. Chance, thank you so much for your question. Appreciate it. Okay, so here's another question from the tax subreddit. And quite simply, we have new to this 1823 asking, is an LLC needed? It says, I own a condo that I rent out to a tenant. Do I need to form an LLC or an S-Corp for this? And he says you're not asking really which, asking more if there's a need at all for this. All right, so with regard to setting up an LLC for a condo, the first question is, are you the only owner of the LLC, or are there multiple owners? Because if you're the only owner and you set up an LLC, that entity is going to be viewed as a disregarded entity, which means that from a tax perspective, at least on the federal side, it doesn't exist. All right, so you're going to be treated just the same as the entity itself, which means that if you had $1,000 tax liability resulting from that condo without the LLC, it will be $1,000 with it. It's not going to be any difference. Okay. And then that brings back the question, why would somebody put their property in an LLC? And the answer is a legal answer, okay? Because there's two aspects to forming an entity that you need to always take into account. One is the legal side, and the second is the tax side. In this case, since having a single member LLC is not going to really do anything for you from a tax perspective if you're the only owner, the question then becomes, will it provide you with the limited liability you're looking for? You have to ask an attorney. What are the limitations of that limited liability? Are there situations where the LLC corporate veil may be pierced, if you will, so that you do have liability in certain cases, right? Because if there is, let's say, you let tenants move into a property that has lead paint and it wasn't disclosed, can that create a possibility that you're legally liable beyond the protection that's afforded by the LLC? Again, an attorney question. So you definitely need to ask the right people the right questions. And in this case, it's a legal question more than it is a tax question. So aside from that, you also asked if it's necessary to put an S-Corp in place. Now, on the legal side, same questions. Are you protected in terms of legal liability? How limited is the liability? And all these different questions. So you want to make sure to address that with an attorney. Then from a tax perspective in general, and depending how things are structured and what you're doing for this condo and if you're providing services or not, generally it's not advantageous to hold real estate rental property inside of an S-Corp, because there's certain things that come into play, like reasonable compensation and the fact that if you're moving property in and out of an S-Corp, there may be some gains associated with that, because those are taxable transactions in general. So you want to be careful as soon as you make that S-Corp election, because you're introducing a whole new set of hassles from a tax perspective that may not be advantageous overall. So on the legal side, you definitely want to narrow down your options, because on the legal front, you can't form an S corporation. That's a tax concept. So if you're thinking about LLC, that's going to be your only option at the state level. You want to understand exactly what the pros and cons are there and flesh that out. Then on the tax side, you want to see if you want to leave that as a single member LLC or make the S corporation election and have to deal with those additional burdens that go along with that. So hopefully this offers a little bit of clarity in terms of the fact that there's the legal side to consider, then the tax side. And you really want to be careful with the S corporation election in this regard, because it may create some complications for you. But again, consult with your tax advisor and go from there. All right, Chance, appreciate the response there. I'm glad that was helpful for you. And yeah, generally, a lot of these tax places that are the big box retail providers out there that you might go to, your local XYZ block location, they're always touting the fact that they'll give you large refunds and this and that. And I always have to slap my forehead when I hear that. I'm probably not going to do that now for obvious reasons, but you get what I'm saying. It's ideal to break even if you can. All right, so here's another question on the tax subreddit. This comes from Tax User 5050, and the title here is S Corp lost for several years. It says over 10 years ago, I created an S Corp for a side hustle business. In the first few years of existence, the S Corp had profit, revenue less expenses, which flowed through to my personal tax return. I stopped activity in the business to focus on my primary job, which is a separate company. I kept the S Corp active with the idea of ramping it back up later on and have been filing annual tax returns. The last few years have had zero revenue and less than $1,000 of expenses, tax filing fees, and so forth, resulting in a loss for several years. I do anticipate having revenue this year or next year for the business, and I'm concerned that having 3 years of loss may raise a red flag, resulting in an audit and a reclassification as hobby business. Does anyone have real-world practical experience with this situation? I can imagine other folks may be in a similar situation and keep a consulting business dormant for many years, in which it would still incur minimal expenses to keep active, such as tax filing fees. Okay, so that's an interesting question because this individual touched on some of the concerns, being that a activity that should be a business, if it's generating losses over a number of years or if there's minimal activity, the question then becomes if it's a deductible situation when all said and done. And in general, the tax laws are written in such a way where they ask the question of, well, if this something's constantly losing money, is it a real business, right? Because generally somebody would shut down an activity that's just generating losses year after year after year. Now, if you had the S corporation and there was activity, meaning you're actively involved in it, you're out there getting clients, you're marketing, you're doing all of those things that a business owner would do to grow their business, then it's okay to have losses generally. So if you have 100,000 of income, but you have 200,000 of expenses, but you're out there hustling and nobody can really deny that it's a business activity, then you're good. But if you have no activity over time and you're generating losses upon losses upon losses, that can create an issue because the IRS is going to pump the brakes and say, wait a minute, you're reducing your taxes on all this other income with this activity that's not really a business. And it can create some issues there. And generally, if you have losses within at least 3 of the last 5 years, then the IRS will have a rebuttable presumption, I'll define what that means, that that activity is a hobby and not so much a business, okay? So a rebuttable presumption means that you can rebut or refute or disagree with that presumption by providing supporting documentation that substantiates the fact that this is indeed a business activity. That becomes more difficult if you have multiple years of no activity, okay? So at that point, you really want to consider if you're going to take those deductions, because by taking deductions for business purposes, you're affirming the fact that it's a business. If something's been dormant for a number of years and it's just incurring expenses, you may want to do some analysis on that front to see if you actually want to take those deductions. So a situation that you may encounter is that you have a business entity that you're paying those amounts for, but you're not deducting them, because essentially those would be hobby losses in some cases. Now, if it's less than $1,000 in expenses, are they going to break down your door? I mean, it's possible, but I'm sure the IRS has bigger fish to fry. But in general, if you told me that this was $10,000 or if this was $100,000 in expenses, no income, absolutely not. Especially if this thing has been dormant for a number of years. And even with the 1,000, there's some place where you have to draw the line and say, okay, well, I haven't operated this activity within the past few years. You shouldn't be taking deductions on it because it's not an ongoing business, so to speak, from a tax perspective. It's just an entity that exists, and there might be a good reason to terminate it moving forward if you're not using it, because if you run afoul on some of these deadlines, like today's, well, technically tomorrow's deadline, then you may have an issue there. So hopefully this provides some clarity there. Tax user 5050, you may want to reconsider taking those deductions if this is a stagnant entity or if this is an inactive entity moving forward. All right, so here's yet another question from Tanho90 on the tax subreddit, and it regards 1120S, which is S corporation tax returns. So it says 1120S amended return question. I recently completed my 2019 S Corp 1120S return. Good job. I later realized that my shareholders basis statement had an error. It's an easy fix, but do I need to submit an amended return to the IRS with the correction? I'm the sole shareholder of the S corporation, so I am the ultimate taxpayer to have the corrected K1 and shareholders basis statement, but do I need to send this to the IRS? So the S corporation tax return does not include a shareholder basis statement when you file it with the taxing authorities, okay? So you do not have to amend the return if that statement has an error. You just want to make sure you track your basis accordingly and go from there. But you also want to make sure that if your losses exceeded your basis, that was taken correctly on the personal return. So for example, if you had $10,000 in basis in tax year 2019 and you had $15,000 in losses, then $5,000 of those losses may have been suspended as far as the basis limitation. So you may not have been able to take that on the personal level within tax year 2019. So that means they're suspended to a later tax year. If that was the case, then your basis would play into the actual returns and how they play out. So in that case, you want to take a look and see if the basis correction had any effect on the amount of losses that you took in a particular year. But if you have positive basis and you had positive income from the S corporation and there are no issues with losses, then it's much more straightforward in that you just correct the shareholder basis statement and you get to rock and roll, man. All right. All right, so here's another question from OW Beginner on the tax subreddit, and it is, can a disregarded LLC hire employees or independent contractors? It says, I formed an LLC for my business with the intention of having it be disregarded, and I want to obtain an EIN for it, but when I started reading the IRS website, it seemed to be the case that LLC cannot be disregarded and also hire employees. Is that right? Can a disregarded LLC hire independent contractors? I'm working with an accountant, but if anyone has gone through this, it would be great to know. All right, so as a single member LLC, if you as an individual form an LLC, it's a single member LLC, it's disregarded, that LLC can use your social security number, but it can also have an EIN or employer identification number associated with it. Now, if you want to have just an LLC all to yourself without getting an EIN, you're good, you can use your social, but as soon as you're looking to hire employees, you need to get the EIN or the employer identification number for the LLC before you can hire those employees, okay? And you possibly also need to get some identification numbers at the state levels as well, depending on which state you live in, so that you have payroll identification numbers for federal and state purposes, all right? So you absolutely can, as a disregarded entity LLC, hire employees. You absolutely can, as a disregarded LLC, have independent contractors that work for it. However, you need to make sure that you have the EIN in place and any state numbers so that payroll can be done accordingly. So all of that's possible. All that's a beautiful thing. Be careful, though, and this is a legal question of classification of employees versus independent contractors, because the rules in this area have changed. In California, you have this whole thing called AB5, which you need to take into account, and that makes it, in some cases, very difficult to justify that someone is an independent contractor versus an employee. However, not giving any legal advice, you need to discuss that with an employment attorney who can guide you accordingly. But in general, just be careful that the independent contractors that are working for you are indeed classifiable and justifiably so as independent contractors versus employees, so you don't run into problems there. But in general, yes, a single member disregarded LLC can hire employees and they can hire independent contractors. Just make sure you get that EIN in place. All right, Chance Carter coming in strong with the questions. I appreciate you. All right, so I just started at a bank, IT director, and was thinking of investing in a CD with them. Any advice to keep in mind for a first-time investor? So The first thing I'd say here is that I'm not an investment advisor, okay? To provide investment advice, you need certain registrations. Right now, I'm not registered as an investment advisor, so can't provide any investment advice. Apologies on that. But in very general terms, not having to do with your specific situation, the answer to whether any specific investment makes sense or is a good idea has to do with your goals and your risk tolerance. All right? And on the goal side, we usually talk about it in terms of what is your return appetite, meaning what do you expect to get out of these invested funds versus what are you willing to risk. Okay, let's take a look at the stock market. In very general terms, if you have all stock portfolio and the market is doing this, you're going to be on that roller coaster. And you have to be okay with that. And I don't think there's a more pertinent time than now to discuss that, because this is exactly what's going on with the market. So if you have your assets invested in all equities, you're generally experiencing all the ups, but all the downs of the market. And you have to be prepared for that. There's no way around that. Whoever tells you that you can get this much return with this much risk, run in the other direction. It doesn't work like that. It just doesn't. So in terms of evaluating a CD, you have to be comfortable with the fact that in general, you're not going to get any sort of appreciation on it, right? So it will not go from $1,000 to $3,100 at the end of the year or anything like that. It'll pay some interest, but it's not going to be an enormous amount of interest. Okay, so overall, you have to be comfortable with those parameters, and you have to recognize that your return is going to be lower, but your risk is lower. Because I'm sure that people, while the stock market is doing this, that have CDs are all good. They're relaxed. They're not sweating because they know that they're covered in most cases and that there's not a problem for them. But then again, if you're looking at who's going to have the most exciting outcome when all is said and done, it's probably going to be the investors who took a little bit more risk over the long term than ones who just said, let's keep it to the CDs. So it goes back to what you're looking to get out of this whole thing. If you're looking for more security and that's your priority, and you don't really want the roller coaster ups and downs of the market, you may consider the CD side of things, but understand that inflation is very real. It's a very real tax, and it's kind of like a hole in a pool, in that you can have your assets sitting in a swimming pool, let's say, but they're constantly going to be drained by that hole being inflation. And you want to make sure you're adding water faster than you're losing it to make sure that your wealth is growing over time. So if inflation is, let's say, 3% on an annual basis, and your CD is returning 2%, then the number in the account may be increasing, but your purchasing power, the amount of goods that you can buy for that money, is decreasing overall. Okay? So when you step back and look at the entire situation in a hypothetical scenario where you have a 2% CD over a year and 3% inflation, you've actually lost money in terms of purchasing power. Now, the purchasing power side of things is kind of the real amount that you're dealing with. The other side is the nominal amount, the numbers, right? So the numbers are going to look like they're higher, but in terms of what you can actually get, the amount of goods, it's going to go down typically in an inflationary environment. So there's some considerations there, and it always goes back to what makes sense for you versus what your risk tolerance is, and reconciling it from there. Personally, depending on what someone's age is, what they're looking to get out of the market, what they're willing to risk, those would all be determinative factors as to whether this makes sense over the other available options. But definitely it's a case-by-case analysis. So hopefully that helps shed some light on the decision process that would go into figuring out if this is a good thing for you. All right, so we're about an hour and a half mark, almost. So that's probably where we're going to cut it off for tonight. But then again, if I'm feeling froggy, we're going to keep rocking and rolling. The tea is still available, which means that I'm still ready to rock. So let's do this. All right, so here's an interesting one from the tax subreddit. This one comes from Gene10642. All right. It says, how difficult is it to handle S corporation payroll / bookkeeping on my own? This is a great one. I'm getting excited. says, I'm a partner in a company that pays my personal S corporation on a K1. Okay. All last year, I was paying an accountant $125 a month to manage my bookkeeping and payroll. I was suddenly dropped by that accountant. I want to figure out what happened there. So now I'm looking for new accountants and realizing I might have to do it all on my own, except for the end of year generation of my S Corp K1 and filing the federal and state returns. Accountants love bagels and donuts and all that other sort of junk food, especially this time of year. So you may be able to save the relationship by showing up with a care package in the heat of battle right now to salvage what's left of your connection with this professional. But anyway, assuming that's not possible, let's continue reading. Last year, my earnings would be deposited directly into my S Corporation's business bank account. From there, my account would generate a pay stub transfer after tax share to my personal account and set up direct transfers for federal and state withholdings. He also filed the quarterly paperwork. Because my accountant dropped me, I was calling around to find an accountant who would do personal and business taxes for $500 total, since everything for the year has already been done except for filing the 2019 returns. The same accountant can also do bookkeeping and payroll for $100 monthly, and the result is $1,700 in fees. Another accountant is saying that he could do bookkeeping for me for a nominal fee of $150 for the year. Okay, so in general, there's a few items here. Now, the first thing is to find a bookkeeper that can help you for $100 a month is more realistic than finding a CPA who would be able to help you for that price. It's a fact that CPAs generally charge more than your everyday bookkeeper who doesn't have any credentials, such as CPA or what have you, or enrolled agent, still also very legitimate designation. So the first thing is I think you should shop around and see what the going rates are for various sorts of professionals before putting a price in place and demanding that be the price that you get. Because what can happen is if you call a firm and say, I want to get X for $100 a month, that may already limit your options. Have a conversation, see what the rates are and see how close you are to those rates. You're going to have a much better time and you probably end up with fewer accountants firing you, I'm sorry to say. Aside from that, if you're doing all the accounting on your own, it's a good bet to have an accounting system. And I'm not a shill for this company whatsoever. I probably hate them more than I like them. But QuickBooks Online, they have a fairly solid tool to keep track of business income and expenses. And one of the best aspects of that is the fact that you can link it to a business bank account. Now you have all the transactions, all the income, all the expenses coming in through the bank feed, and you're able to classify all those different expense items, make sure the income is accounted for correctly, and so forth. So in general, it's a beautiful tool to have. And once you have QuickBooks Online in place, it's very important to understand that that doesn't make you an accountant all of a sudden. And this is a misconception that QuickBooks Online has put out there and Intuit has put out there that says that once you get our software, you're all of a sudden an accounting expert. Unfortunately, more often than not, I see, and I'm just keeping it real, atrocious accounting come out of QuickBooks Online because of that misconception. So your ideal bet is to get QuickBooks Online going and have a bookkeeper, if that's within your budget, or a CPA if that's within your budget, help you throughout the year. Either understand how to do it yourself, schedule a consultation, have them walk you through it, answer your questions, get you set up so that you can do it on your own throughout the year, or you want to pay them throughout the year, be it quarterly, monthly, whatever, to come in and actually update the books and get the transactions in there and so forth. The biggest challenge I see here is, first of all, you want your business and personal returns done for $500. That's going to be difficult if you're looking for a CPA to do it. It's on the low side. There's a lot of variability in terms of fees, but I can tell you that that's going to be tough to meet even for some of the big box retail tax locations, but certainly free to ask around. And ultimately, whichever path you take, I think it's going to be constructive to reach out and see what the prices are in your particular area versus having a number in mind and then demanding that be the price. Because a lot of firms, just to keep it real, they're going to see that you're demanding certain cost for a monthly basis, quarterly basis, what have you, and that's going to taint the relationship from the beginning, okay? Because putting that price limitation right up front gives very little room for flexibility. And see if they can also customize their offerings to meet your budget. That's also an option, right? Everything here is negotiable generally. So hopefully that helps and prevents other accountants from firing you. Again, bagels and donuts are always appreciated, and any other sort of junk food that wouldn't hurt, okay? Hopefully that helps. Gene 10642. All right, so here's a question from Sir Wilfred. All right, this is a noble character, I can already tell. This has to do with estimated tax installments and penalties. It says, assume my annual 2019 taxes owed were $200 and my 2020 taxes owed are $25,000. If I pay $200 in 2020 tax installments to the IRS to match my prior year tax owed, will this keep me in the safe harbor rule and exempt me from penalties or interest? Excuse me, my question pertains to tax installments only. I'll be paying the taxes in full by April 15th, 2021. All right, so great question. And I constantly get inquiries about the safe harbor for estimated tax payments. And this is something that comes up pretty frequently. Now, the way the safe harbor rule works is that if you have total tax liability, let's say in 2019 of the $200, and in 2020 your tax liability is $25,000, if you make timely estimated payments, or if you have withholdings of $200 throughout tax year 2020, then yes, you can pay the additional taxes owed by the deadline of April 15, 2021 without penalties or interest. All right. The only wrinkle in that is if your AGI, or adjusted gross income, exceeds $150,000, was $150,000 or more in 2019, then you don't have that 100% rule being the $200 in your case. It's 110% of the prior year total tax, which would be $220 in your case. So as long as you have $220 paid in with withholdings and or timely estimated payments throughout 2020, then you are not going to be subject to penalties or interest on that additional amount. But keep in mind, if you file an extension on April 15th, 2021, and you don't pay the amount owed on time, still by the April 15th deadline, you're going to have penalties and interest assessed there. So you definitely want to make sure that balance is paid at the tax filing deadline, April 15, 2021, and you should be all set. So again, it's 100% of prior year's tax if your AGI is less than 150,000. If it's more than 150,000, then it's going to be 110% of prior year tax, which is $220 in your case. So you do have an opportunity in this situation to actually have those funds working for you, meaning having them invested throughout the year possibly, instead of paying them in as estimated tax payments and then finally making the payment with the filing of the return with no penalties or interest, okay? At the state level, generally it's also applicable, but you want to confirm with your particular state that they do abide by this rule and they make that safe harbor available. All right. All right, here's yet another question from r/tax. This one is from Sherwalk, and he asks, stocks on taxes? I think you mean taxes on stocks, but we'll get to that. So it says, hello, I'm currently just turning 18. Happy birthday. I invested in a few ETFs and some regular stocks and such at the beginning of tax year 2020. I wanted to know advice on how to report this on my taxes for next year. So if you're investing in equity securities, so basically ETFs, assuming they're equity ETFs, I'm going to define all of that. Let's not get too technical. Then essentially, you're going to be looking at a few different things, right? There's dividend income that could come in throughout the year. So that's paid on any sort of the stocks that are held by the ETF. That generally gets paid through to you as the end shareholder. So there's going to be dividends there. Then if you have fixed income based ETFs, meaning they're holding bonds, then you're going to have interest income throughout the year. That's going to be generally taxable. So you can have dividends that are generally taxable. You can have interest income that is generally taxable. And if you have transactions when you're buying and selling those ETFs, that can generate capital gains or losses. All right. So you have to take all those different things into account to figure out what the tax implications are going to be. Now, on the stock side, you can have the dividends getting paid in, and some of those may be returns of capital. Some of those may be actual qualified dividends and so forth. There's a few different flavors of dividends. All right. And that's all going to be reported on Form 1099B, typically, that you'll receive from whatever brokerage you're using to custody those assets. So they're going to take care of a lot of this reporting for you, but it's a matter of making sure you report it correctly on your tax returns at the end of the year. So watch out for that Form 1099B. Similarly, that Form 1099B will also include information about any sort of interest that was earned throughout the year and also the nature of that interest as well. So it may very well be that some of it is interest from Treasury, some of that is municipal bond interest and so forth. And they have different flavors from a tax perspective and different ways that you treat it. But overall, all of that information will be included on Form 1099B. Similarly, you'll also have information on any dispositions that occurred throughout the year. So if you bought and sold securities, the gains and losses are also going to be included on that form for reporting, typically on Schedule D of Form 1040. So your 1099B is going to be your guide to determine how everything should be reported. And then it's up to you to actually report it correctly. It's not done automatically, unfortunately. Now, one question that plays into it is if you're going to have adequate income to actually file a tax return, right? Because if overall your income is less than the standard deduction, typically of $12,400, if you're filing single, then you may not have to file a tax return to begin with. So make sure that, first of all, you're required to file a return. If so, use the 1099B, and that's going to be your guiding light to tax heaven. All right, so here's another question. This one comes from Alit1996. This is his first time doing taxes without parental help. Says, I've just a stupid question real quick. There are no stupid questions. I've never done my taxes alone, and I'm a bit confused. I'm filing online with H&R, and I did one set of my W-2s. I have the same employer all year, and I have one W-2 for state and one for federal, but they both have the same information. Do I just add the one, or do I add both? All right, so typically with W-2s, there's a few different requirements that need to be taken into account, right? One is the federal level, what did you earn? And at the state level, what did you earn? If you didn't move from one state to the other throughout the year, they're probably the same, unless you worked in a different state. Okay, so if everything was in, let's say, California throughout the year, then you should be able to simply input into the tax software that you were a resident of California throughout the entire year. You didn't work outside of the state. If that's the case, you should have the same amount of W-2 income reflected on your 1040 and also on your 540. So just check those forms and make sure that the wages amount is correct at the federal and state levels, and you should be all set. The only time this can become an issue is if you have one W-2 for federal purposes and then multiple W-2s because you worked and earned income in different states, and that's when the reporting can get a little bit more tricky and involved because it may require the filing of part year returns and all this other stuff, or non-resident returns, what have you. But in your situation, you should be all good. The amounts being the same mean that most likely everything happened in one state. So you should be able to dial in at once and see it reflected at both the federal and the state levels. All right, here we have a question from Abel Fabula. Pardon me if I didn't pronounce that correctly. All right, so let's see here. Can a single member LLC file as an S corporation for 2019, late election form 2553? The Secretary of State registration was on June 2019. Okay, so the Secretary of State registration was on June 2019, and essentially you're looking to make a late S corporation election for the year. Okay. All right, so the late S corp election, you want to make sure that, first of all, the S corporation makes sense. The S corporation election, makes sense. What I see happens more than anything is that business owners do a lot of reading online, on forums, on all sorts of business websites, and they learn that as soon as you want to make a business, you form the LLC and then you go directly to the S corp election. And more often than not, I see that creates more problems than it solves, because the S corp election brings with it certain administrative burdens that are not applicable to single member LLCs. So, for example, you need to figure out what your reasonable compensation would be. All right, there's a cost in and of itself with an S corporation. Then you typically need payroll done to pay yourself that reasonable comp. So that's yet another cost that you have throughout the year. It's also very helpful to have proper accounting in place. So you may need to pay an accounting service or a bookkeeper to keep track of all that for you throughout the year. That's usually beneficial as well. And sometimes at the state levels, S corporations may be subject to additional taxes as well. Here in California, the net income of the S corporation is subject to a tax of 1.5% with a minimum of $800 per year. So you have to kind of ask yourself all those different questions as to whether the S corporation election makes sense. Now, generally you have within a certain amount of days after the beginning of the year, there's about 75 days that you're allowed to have to make the timely S corporation election. Now, you're way past that for tax year 2019. So one option that you may have is indeed making the late S corporation election. But you have to make sure how things were laid out for you, because if you had high net income from the S or corporation, or from the LLC rather, throughout the year, and you didn't take any reasonable compensation, you may create a problem for yourself by making the late S corp election, and now you didn't take payroll throughout the year. That may create a different problem for you. So in looking at 2019, you have to evaluate whether overall it's beneficial for you to have that election in place based on how the numbers played out. And if it is, then you typically may make a late S corp election if you were treating it as an S corporation the entire time, which means that if you've already filed your personal returns for 2019 and you didn't reflect that income or that flow through as if it was an S corporation election, that may limit your options, because that late election was created specifically for situations when everything else was done as if it was an S corporation, except the actual election was not filed. So it's not for situations where it was completely not even a consideration, then all of a sudden somebody wants to do it. It's geared for situations where everything else aligns. It's just that the S corporation was not filed, the election was not filed. So there's a little bit of analysis to do as to whether or not it makes sense for you overall, having an S corporation election in place versus just a single member LLC. What are the benefits that you're looking to get out of it? And what is scenario A, being single member LLC, look like overall when everything's said and done versus scenario B after you take all those taxes and costs into account? That's number one. You want to make sure the S corporation election makes sense. I see it taken way too early. And it kills me because it weighs down businesses when business owners figure out all the things they have to deal with regard to S corporations. They're like, this is crazy. If I knew all of this up front, I would have never done it. So with that, you want to make sure that you make the right decision up front. Second, if you establish that it is something that makes sense for you, if you haven't filed your 2019 returns yet, there may be the opportunity to make that late S corporation election and have that treatment effective as of the first date of the formation of the entity. But I would suggest that you work with a CPA to make that late S corporation election to make sure that it's done right, because there's a few little technical things and you have to make the filing exactly correct in order for it to be applicable. It's a little bit tricky, so it's helpful to have a CPA get you through that process. But generally, you can file a late S corporation election if you've been treating it as an S corp since its inception and that there weren't tax returns filed that suggest otherwise. All right, so hopefully that helps. And let's see if we have other questions coming in here. If not, we're probably going to wrap this up a little bit here for today. I mean, this may be something that we do on a continual basis, but we're almost at the 2-hour mark, and I'm running dangerously low on tea, guys. I mean, it's almost a problem. Okay, so here's an interesting question here on the tax subreddit, and it's simply titled, "I'm dumb." All right, so we're going to get that figured out. I'll let you know if that's the case. Form 8948, where it says either basis reported to the IRS or not reported to the IRS. I submitted my taxes with B checked off, meaning not reported, when I should have said A, reported. I also sent a summary of all my transactions, so there's no problem there. As far as I know, the little check mark is the only thing wrong with the whole return. Should I send an amended tax return? What should I do? So first of all, you need to change your name, okay? Second of all, you need to move to a country that doesn't have an extradition treaty with America, all right? Thirdly, you need to destroy all evidence of your identity, all right? And don't contact any of your former family members. I'm kidding, all right? So in this situation, you reported all of the cost basis, you reported all the proceeds, you're probably okay, All right. Usually for amended tax returns, we want to see that there's a difference in tax liability, right? So if your liability goes, from like the previous example, $200 to $25,000, that certainly warrants an amendment. But if it's a simple checkbox here and there that doesn't have any other effect but just that little designation there, you're probably good to leave it. It's not world ending, because what can happen is that if you file an amendment for this thing, then you may need to file an amendment later on for a more substantial reason, and now you're filing an amendment of an amendment that warrants additional attention. You don't need it. You sent in the summary transactions, you checked off the wrong box, you're probably okay. There wouldn't be a difference in tax either way. But certainly if you're thinking about amending a return, you're probably okay to let this go. If IRS has questions, they can reach out, but we don't want to file tax returns unless there's a real reason to do so. So hopefully that helps. You're not dumb, believe me. You don't have to leave the country or change your name or anything, but you may have to break up with your significant other still. Okay, so here's a question regarding stock basis or lack thereof. All right, it says, this is a question by Biff057GF. All right, it says 1099B form with no purchase date or basis. Okay, quite a common issue. Hi, I'm free filing using H&R software. In 2019, I was told that I'd be getting a check for around $1,000 because years ago, my grandfather had some stock, had bought some shares of Royal Bank Canada and trusted them to his grandkids, and that some of the shares had been sold. I'm trying to enter this information to the software. However, the 1099B form doesn't provide a purchase date or basis, and I need these two things to continue in the software. The form 1099B does have a form checked saying the net proceeds have been reported to the IRS. Do I still need to file this form if that's the case? I'm guessing yes, because the 1099B says federal income tax has not been withheld. Great question. Now, the 1099B should include two things ideally if there was stock sold. One of them being the proceeds, what you got, so the $1,000 in this case. The second one being crucial is the cost basis, and along with that, the date of acquisition is also helpful. Now, let's call it three things. So you got the basis, you got the proceeds, and you got the date of acquisition. In this case, we only have the proceeds amount. We need the two other details, because what happens is if you don't have evidence or substantiation for the stock basis, the IRS simply assumes this guy, zero. So what would happen in that case is you'd have $1,000 of some sort of long-term or short-term capital gains with no cost basis to offset the gain, which means that you essentially add $1,000 to your income and pay taxes on it. What you want is to have a cost basis to input in there to offset the tax liability. So if the cost basis is $900 and the proceeds were $1,000, you're only going to be taxed on that difference of $100. And that could be a long-term capital gain, short-term capital gain, depending on how you received the shares. Probably given the fact pattern here, it's long-term, but we need to know more. So ideally, you'd want to trace back to when your grandfather bought those shares, get the acquisition price, and then you need to follow it through in time to figure out, well, were those shares inherited? Were they given as a gift? Those things will have different implications as to what the cost basis is. So let's say cost basis was $100, and your grandfather held those shares until he passed away, and at that point the fair market value was $500. They may very well get a step up in basis from the 100 to the 500, which means that if those shares were then given to you as an inheritance, that difference between the 500 and the 1,000 proceeds would be the amount of gain that you take into account for tax purposes. There's some work involved there because you need to understand the timeline of when the shares were acquired all the way to when they were sold after they came into your ownership. Now, with that said, if you can find that information out and you have some sort of substantiation and reasonable basis for calculating that cost basis, then certainly take that into account, because if the IRS questions it, then you're going to need to explain how you came up with that figure. Worst case scenario, if you don't have any cost basis information and at the end of the day you don't want to deal with it and you don't care, zero is your cost basis. Okay, so you'd enter that in the 1099B. If these shares were held for longer than a year and a day, typically it's long term, and you would check off the box that says that cost basis information was not reported to the IRS. So with that, you're going to have that added to your income. And if you are above the thresholds for filing, then you're going to be subject to some additional tax liability. But at the end of the day, that'll take care of your reporting requirement and prevent, I should say, an IRS notice from showing up and ruining your day. So hopefully BIF 057GF, that helps. All right, so now we're at the 2-hour mark here. I'm going to check one more round of questions, guys, and we're probably going to wrap this up for today. But other than that, today has been a lot of fun, more fun than I deserve to have on a weekend. All right. Hopefully I haven't been talking to myself for the last 2 hours because I've never actually streamed before. So it may very well be the case that none of this is actually going anywhere. But hey, what are you going to do? And if you haven't subscribed already, what are you thinking? Subscribe to the channel right as we speak, because there's going to be more live streams. There's going to be more content coming on. So there's going to be an avalanche of good stuff. Hit that subscribe button and also that bell icon. Destroy that bell icon, all right? Crazy. Just do things to it that, never mind. All right, so we've hit the 2-hour mark, ladies and gentlemen. Thank you so much for tuning in. I appreciate the questions. Hopefully you guys got some value out of this, and look out for more live streams because they will be coming up soon. And now I have to figure out how to turn this off.